Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome to episode 303 of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvely, bring you everything you need to know from the past week in the world of financial markets and financial planning. Nick Whitaker is back filling in for Matt this morning, so as always, Nick, it's good to have you back.
Good to be back. As always, excited to get into it.
Been a little bit of time, but good to get your opinion on things as they have transpired over the past couple of weeks here. But before we get into that, if you have been enjoying the Independent Advisors Podcast for a while now and want to take the next step in your financial journey, I'd encourage you to head to our website, jessupwealthmanagement.com. Matt offers a 15-minute initial call where you can discuss your financial goals and see if JWM is a good fit for your needs. Scheduling is easy. Once you land at jessupwealthmanagement.com, just click Schedule Initial Call and select a time that works best for you. There's a quick survey to fill out that will help guide the conversation and ensure your time is used efficiently. If you're ready to learn more, visit jessupwealthmanagement.com and book your call today. As always, we will quickly review the month-to-date and year-to-date performance of the major market indices that we track. This data is from Y-Charts and as of the market close on June 4th. S&P 500 index up 1% during the month of June and up 1.5% for the year. The Dow Jones Industrial Average up 0.4% to start the month and down 0.3% for the year. The NASDAQ Composite Index up 1.8% for the month and up 0.8% for the year. The Russell 2000 Small Cap Index up 1.6% for the month and down 5.7% for the year. And the Vanguard All World X United States Index Fund up 1.2% in June and up 15% for the year. 3-month Treasury rate at 4.44%, the 2-year Treasury rate at 3.87%, and the 10-year Treasury rate at 4.37%. So I guess that's one thing that caught my eye here just recently, Nick, is that 3-month Treasury rate has creeped up more and more, it looks like, over the past couple of weeks. So that's an interesting development, something we haven't seen in several months.
Mm-hmm. Yep.
Moving on to big headlines and current events from this past week. S&P 500, Nick, just had its best May in terms of performance in 35 years. I think a lot of people or people that watch CNBC or the major financial media news outlets, there's a phrase in our industry that people say, sell in May and go away, because typically the strongest performance is from roughly October through April, that roughly 6-month period. But it just goes to show you that after markets recovered their April losses from the Liberation Day sell-off, May continued to be a great month for stocks. So I think it just goes to show you, as we've talked about before on this show, is that strength begets strength. And even though I'm going to have a piece here in a little bit that talks about this, where the markets jumped up really quick, really fast. I think it was 12.5% over a 10-day period or something like that. And people are like, this can't last. And that was, roughly in the beginning of May, and look how the rest of May turned out. So it was a great month to be an investor in the stock market. Weekend news hit that the U.S. will be doubling the tariff rate for steel and aluminum imports up to 50%. Doubling to 50% effective on Wednesday. So that's yesterday. That continues to be an ever-evolving situation. So no major updates on that front. On Friday, tomorrow, June 6th, the monthly jobs report is set to be announced for the month of May. So there's going to be a lot of eyeballs on that to kind of gauge an indicator of strength in the economy. A couple pieces of econ data for everybody. So on May 30th, the PCE, or Personal Consumption Expenditures Price Index, was up 0.1% month over month as expected, which left it up 2.1% year over year. We're continuing, Nick, to see inflation rates moderate, which is a great thing. And the consumer is still doing really well. Personal income growth is strong, and personal savings rates actually ticked up to 4.9% from 4.3% in March. It wasn't too long ago where, we were talking about others in the industry saying that, the COVID savings are completely gone, and people's debt is up and their savings are low. And, surprise, surprise, just over the past couple of months, we've seen that savings rate tick up a bit, which is great.
Yeah, and I think importantly, we saw a bunch of help for the consumer over the past year with wage growth. And I think that's the other piece of that story, which is like, okay, well, what's the change there if people went through their COVID savings? And that's the answer, in my opinion.
And that's just from the conversations that I've had over the past, call it 6 months. Everyone's aware that prices are higher, right?
Absolutely.
But most people that I've talked to just don't really notice it because their income has kept pace with that, right?
Absolutely.
Which is interesting to note. But last but not least, consumer sentiment numbers released on May 30th increased to 52.2, better than the consensus of 51. This ends 4 consecutive months of plunging declines in sentiment, although consumers obviously still have concerns. And I have a piece on this right now, actually. So we'll just go ahead and get right into the tweets, articles, and research from this week. First thing I had was a post from Ryan Dietrich on X on May 27th. Jenna will put this up on the YouTube video. This will also be in our show notes. He says, finally more AAII bulls than bears after 15 consecutive weeks. Turns out when long streaks of bears greater than bulls ends, it's quite bullish. S&P 500 up a medium of nearly 22% a year later, and at least double digits 7 of 8 times. And just for fun, 2008 was the one time that it didn't work. So again, for maybe newer listeners, the AAII stands for the American Association of Individual Investors. And every week they ask a group of individuals, or, quote unquote, regular investors, how they feel about the stock market for the next 6 months. And there's 3 options that investors can pick. Bullish, which they mean stocks they think are going to go up. Bearish, they think stocks are going to go down. And neutral, they think stocks will stay about the same or just chop sideways. So the survey shows what percentage of people are bullish, bearish, or neutral, and it's used sort of as a sentiment indicator, kind of like taking the market's temperature as a simplistic example. So typically we've used this or talked about it in the past, Nick, more of a contrarian indicator. So when there's too many people that are very pessimistic on stocks going forward, usually we're getting closer and closer to a market bottom, and vice versa. When people are overly optimistic, typically we're closer to at least a short-term top. So just because people have marginally gotten a little bit more bullish over the past week doesn't mean the party's over, in my opinion.
Yeah, absolutely. And to clarify, the consumer sentiment that we talked about and the headlines, that's a different consumer sentiment report. That was the Michigan survey. So you'll hear those are 2 different ones. They're gathered obviously in different ways through different surveys. However, the data is always similar.
Yeah, it is.
There's always a lot of overlap there.
So moving right along, another follow-up to one of the things we talked about a few minutes ago, Nick. This was a post on X from Jeff Weniger all the way back on May 1st, actually. And Jeff says this: it feels like too much too fast. The S&P 500 has jumped 12.5% over the last 17 sessions. And as a reminder, this was back on May 1st. For many investors, instinct says sell, take profits, wait for a better entry point, but history says to ignore that instinct. From 1988 to 2025, there were 13 other periods where stocks rallied at least 12.5% over 17 trading sessions. Most of the time, stocks kept going higher afterwards. It doesn't work every time, see 2001 to 2002, but the table has had a lot more green than red. And it's very uncommon usually, Nick, for tweets or posts on X to age this well. This aged like a fine wine. So again, this was back on May 1st. And like we talked about earlier, it may have felt a little uncomfortable to stay invested after that huge rally we saw over 17 trading sessions. But those who stayed invested throughout the month of May got rewarded, and this data backs up that decision to do that for a lot of people, I think. So great post from Jeff. And like I said, it aged very, very well, at least over the past month.
Yeah, absolutely. I was just looking at the data there.
Yeah,
it looks like most of the data is even in some like hot spots of the market, 2001, 2002, but even late 2002. So I'm trying to see if that's 1030. Yeah, still ends, 250 sessions later, up 20%, 200 later. Yeah, so when you look out really long, it still is, it shouldn't be this point of, we're due for another bear market. I mean, it might take some time, but that's why we're in the market.
Right. Yeah. So I encourage you to check out our show notes if you're not watching on YouTube, because you can see the forward performance after similar instances like this have occurred. So last thing I had was a post on X from Subu Trade on May 12th. So he says the VIX is on track to close below 20 today after being above 45 just a month ago. Here's what happened when the S&P 500 did that in the past. So it shows all of the times that the VIX, or the volatility index, or the fear gauge as some people call it, rises from above 45 to below 20. And again, for newer listeners, the VIX is a way for us to gauge fear in the market, gauge volatility in the market. It has to do with the S&P 500 and volatility over the next 30 days. And as you can see here, Nick, each time this has happened in the past, stocks have gone on a year later to be up 100% of the time for an average of a little more than 13%. So when the VIX is rising, that means investors sense a little bit more fear, a little bit more volatility in the market over the next month or two. And when the VIX is falling, that just kind of signals more of a calming state, right? So each time the VIX drops significantly like it just did, it's something that we should be aware of as investors, because it could potentially mean that returns going forward are going to be better, and or the market bottom has already been in. So in my opinion, if the bottom was not made in early April after the tariff announcements, we wouldn't see the VIX as low as it is now. Just my 2 cents. Not saying that it can't happen, but I do truly believe the worst of it for now is behind us, just because of the way this volatility index is acting. I believe as of yesterday, it was sitting around 17, 18, which is a long ways away from where it was and where it peaked in early April. Yeah,
it's pretty funny, having followed the market for in my entire career, pretty long time, and it's funny when you're following the market and you're in the industry every day and you're really listening to things and reading things, you can feel when the VIX has fallen. Things feel calmer, the market feels calmer, the news cycle feels calmer. I mean, versus 45 and 20, I mean, it feels different.
It feels way different.
Yeah.
And it was kind of funny because when a lot of this was going on in early April, I was with my two brothers, and they're both in the industry as well, and we were kind of talking about things and what we thought was going to happen. And we were looking at the market; it just kept falling and falling and falling, but the VIX wasn't like spiking yet, and I was just like, the VIX isn't high enough yet. So I still think we got some more pain to go, and ended up being the case. And I think, pre-market it peaked around 60 or 65, but on a closing basis got to around 50 or something like that, and started to fall from there. So it is a nice signal to kind of say, hey, the worst of us is behind us at this point, but the VIX can go a lot higher than 45, which it has in the past. If you look at this chart from Subu Trade that I've been mentioning, back in the mid to late 80s, the VIX was
87 probably.
140 in the Great Financial Crisis, up to looks like around 80. So, so this isn't an indicator that says how high it's going to go. It's just when volatility spikes, we get a big sell off, and then volatility starts to calm down a bit. Usually is a good sign for stocks going forward.
I like how you described it in a newsletter recently that goes out to our clients in June. If you're a client, you're listening, take a read on that if you're wondering about the VIX, because it's explained very well about, think of it like a temperature forecast,
right?
Where the VIX is really high. The markets are expecting, market participants are expecting the markets to behave in a stormy fashion. When it's low, sunny skies.
Yeah, sunshines and rainbows, baby.
Yeah.
I'll turn it over to you.
Okie dokie. The first thing I have is an update on the U.S. dollar. This is from a Bloomberg article on the 1st of June, titled "Wall Street Sees Deeper Rout as the Dollar Nears 2023 Low." Some of the Wall Street banks, including Morgan Stanley, JP Morgan Chase, are predicting that the U.S. dollar will weaken at anywhere from 9 to 15% due to further interest rate cuts, slowing economic growth, and President Donald Trump's trade and tax policies. I'm not going to read the whole article, of course. I'm just going to read a snippet that kind of jumped out to me, one which is coming from a tax risk perspective. For Goldman Sachs, investors are particularly focused on a potential change to U.S. tax rates on foreign individuals and companies. The measure is buried deep in the tax and spending bill that Trump is muscling through Congress, and it calls for, among other things, higher taxes on passive income, such as interest and dividends earned by investors who are potentially sitting in trillions in American assets. Here's a quote from an investor. In the article, it says, even if the application is relatively narrow, such a tool would exacerbate concerns about risks of U.S. investments at a time when investors are already looking to shift cross-asset correlations as a reason to seek greater diversification away from U.S. assets. In a separate report, Goldman Sachs strategists said their models suggest the dollar is about 15% overvalued and therefore is subject to further fall. The decline would likely be driven by reallocation, repricing of global assets. So one of the things that was kind of interesting that just, kind of made my head turn a little bit was the idea of increasing taxes on passive income for foreign investors that could maybe continue some of the asset allocation that we've seen year to date. So if you go back to the beginning of the show and think about the numbers that we were calling out year to date, the Vanguard FTSE All World ex-US index is up 15% year to date. So we talked about it a lot over the past couple of years on the podcast, when are global stocks going to show up? And they showed up this year for the first time in a little over a decade, I believe.
Yeah.
And so this article is kind of maybe shining a light on that and saying, pending on some of the changes, you could see some of those continued rotations, and it might encourage foreign investors to continue to maybe stick with the allocations, at least in the short term being, let's say, 6 to 18 months, while some of the policy is getting kind of worked out.
Yeah, I think it's pretty simple, right? If it's no longer as attractive to invest in the U.S., if you're a foreigner, you're going to find other places around the world to do so, right? And it's the very classical dollar trade is, short dollar, long international equities, right? And that's exactly what we've seen so far this year.
Exactly.
But we have seen similar instances of this dollar weakness and international equity outperformance on a short-term basis throughout the past 10 to 12 years, and it hasn't materialized into anything bigger than that. But with what's going on with global trade right now, this could be the turning point where international stocks start to outperform U.S. stocks going forward on a long-term basis. I still think we need to see a little bit more than just what we've seen right now, because, like I said, there's been similar instances in the not so recent past, or not too long ago. So it could very well be a new rotation into the world ex-US, but that's just going to take time to see how that plays out. And I think that the trade policies that come out over the next 6 months are going to have a major effect on that.
I think they'll have a huge impact, and that's when you might see the VIX spike a bit, depending on where those end up settling. And another thing to consider, and I don't want this post to make investors too negative on the U.S. It's not my intention. More just it's an interesting point. Where I think this trade unwinds is with the earnings growth profile of developed nations relative to the U.S. and the Mag 7, and if the earnings growth doesn't entice investors enough to sit there, we could see this trade unwind a bit. In that short-term window, again, 6 to 18 months. That wouldn't necessarily surprise me.
Yeah, well
and,
said.
And I have more on that in a couple minutes.
Teeing yourself up.
Yes, I am, on purpose. So the second piece I have is gold or gold stocks, or gold and gold stocks. It's an X post from David Keller on the 3rd. He says gold stocks breaking to new highs this week. I believe he meant to say gold is breaking to a new high this week. But the real story is how much gold stocks have been outperforming physical gold. And then he has a chart here, and it's a big chart, pretty detailed. But the bar that we're really focused on is the third panel down there, which is the relative performance of gold stocks relative to gold. And you can see since the beginning of 2025, the relative performance has been notable, i.e. gold stocks are performing better than gold, which is not bearish.
No, it's definitely not. I think, gold mining stocks and junior gold mining stocks are considered some of the more risky areas of the market. So when you see those names start to outperform, I think it's a good sign long term for the market in general. And again, this, the relative performance that you're talking about, essentially that's just comparing one investment to the other, right? Instead of just having a price chart of gold, you can compare, gold stocks to gold. And if that chart is going from the lower left to the upper right, that means gold stocks are outperforming gold.
Yep.
And if that chart is in a downtrend, it means the other way around. Gold is outperforming the gold stocks or gold miners. But in this case, pretty much through all of 2025, gold stocks and miners have been outperforming the actual asset of gold, which is good to see in my opinion. So we'll see where it goes from here, but it's been a little bit of time since these things have gotten going.
Yep, absolutely. Another interesting point for listeners. And my last piece is checking in on the Mag 7. This is from a research post from the Daily Chart Book on the 2nd of June. And there's two charts. I'm giving listeners a 2-for-1 here. The first one is hedge funds versus the Mag 7. Despite last week's significant buying in tech, hedge fund exposure to the Mag 7 remains at 5+ year lows, which is interesting. If you look at this chart that we'll throw up here, it's been steadily declining, generally speaking, over the past 5 years, which tells me that There could be a bit of a rotation back to earnings at some point. Interesting, nonetheless. Any thoughts before I go to the next one?
I think it would surprise people that some of the larger institutions in the world have been decreasing their exposure to a lot of those Mag 7 names. So let's see if I can rattle them off the top of my head. So that's Amazon, Apple, Nvidia, Tesla, Google, Microsoft.
You said
Facebook or Meta.
Yeah. Meta.
So, which is interesting because some of those names have done really, really well over the past 2 years and some haven't, right? But it is interesting. Does this mean that those stocks are dead and they're not going to make any money anymore? Yeah. No, definitely not. But
is their growth profile maturing? That's a big question, I think.
Right.
And it's the question is it maturing relative to other areas of the market that are steadily growing?
Right. And the other thing to think about too is a lot of these institutional, hedge funds, bought these names when they were itty bitty companies, right?
Yeah.
So back in like the early 2000s or the mid 2000s. So, at some point they want to cash their check on that, right?
They need to limit some of their exposure.
Yeah. So that's all that could be. I don't think people should be reading too much into this, that this is death to the Magnificent Seven or large cap tech in general.
I agree. I think if anything, it's a bit of consolidation and just a bit of asset allocation defensively. And like the article pointed out, or the research pointed out, they have been buying tech. They're still bullish on tech. It's probably just more of an equal weight right now, wait and see, if you will. The next chart here is about the Mag 7 EPS growth. The Mag 7 reported year-over-year earnings growth of 27.7% in Q1, nearly 3 times that of the other 493. And this is the story where I think you can see that European trade or international trade start to fall apart a bit, as if the earnings profile of their top companies, the leaders on their indices, don't compare well with the stats that we're looking at here, and that's kind of what I'm really curious to see how it shakes out.
Yeah, it's just, if you want to look at the market on a very simple basis, money is going to flow into names that have the best, most consistent earnings growth, right? And if the Magnificent Seven is still blowing the other 493 S&P 500 companies out of the water, then more money is going to flow there. If not, then it's going to go the other way. So the earnings growth is still there for right now, and obviously
Absolutely.
that can change pretty quickly. But for now, it doesn't look too concerning to me.
Absolutely. Yep. That's everything I had. So hopefully listeners enjoyed more talk on the Mag 7, and a disclaimer there that any names that we talk about, individual names, it's not a advertisement to buy or sell. We're simply talking.
Thanks for putting your compliance hat on in the absence of Matthew today.
Yes.
So, moving on to the financial planning topic of the week. This was a blog post from Mike Piper titled "Almost Every Financial Planning Decision Requires Judgment." So he says, we can use the latest and greatest financial planning software. We can have encyclopedic knowledge of all of the relevant tax and Social Security rules, which in my opinion is nearly impossible because it's always changing. Mm-hmm. But I digress. We can know that all the details exactly of how all the financial products work. We can have access to the detailed historical data of 100 plus years of investment returns. We can have a thorough understanding of all the pros and cons of each option. But in the end, even with all the above, almost every major personal finance decision will still be a judgment call. I often see people on personal finance forums who seem to be operating on the assumption that they can follow a path of math. Research, math, research, certainty. If they haven't yet arrived at certainty, well then, they probably just need to do a little bit more math or research. Perhaps there's a new piece of software that will get them there. There's always uncertainty. We don't know how long you'll live. We don't know what investment returns you'll get over any particular period of time. We don't know the details of future tax legislation or when such legislation will be passed. We don't know exactly when you'll have to replace your car, replace your roof, pay for a surgery, or stop working because you just can't handle it while you're going through chemotherapy. Life has uncertainty, lots of it. The point of financial planning isn't to remove the uncertainty. That's not possible. The point of financial planning is to help us recognize and accept the uncertainty and make informed decisions in light of that uncertainty. There's always going to be uncertainty, so there's usually going to be multiple approaches to any given question that are reasonable. At some point, we just have to decide. Very simple, but I think a very good explanation of what our industry is. Because when I first started in the industry, I even fell prey to kind of chasing all of these different softwares to get the exact right answer for every single one of our clients. And it's just not possible. There are too many things in life that we don't know about. And I always like to say that a financial plan is just continuously evolving. It's never create the financial plan, implement the financial plan, and then set it and forget it, because life changes and things pop up, right?
Absolutely.
So it is an ever evolving process, but the more we can understand where a certain individual is at life, what their assets look like, what their goals look like, we can make better and more informed decisions for them than going about making decisions without a plan in place. So Mike always does a really good job. I'm subscribed to his newsletter and is always really good at breaking down some of this stuff, which he does a lot better than I could ever do. So that was well said by Mike. Anything else before we leave it there for the week?
No, I like that. I like that piece. Planning for uncertainty is a good way to think about it.
Yeah.
Or in light of that uncertainty. It's
right.
good.
Well, if that's it, we will leave it there, and just wanted to thank everyone for listening to episode 303 of the Independent Advisors Podcast. We will be back with you next week for episode 304.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.